Okay. So monetary policy challenges for the global economy. Thank you.
Oh, well done. He handled it pretty well. He's like, these issues are very important, but let's try to stick to the topic that we're literally here to discuss. And let's leave that for another forum.
No, I don't. Let me check. We might have to go to.
I'm going to remove the long position for now. If it breaks back above support, then I'm going to consider the longs. But for now, it kind of looks like sellers are taking over. So I'm going to put that off to the side for now.
Not at all. No, don't worry about it.
But that would be the second trade.
Okay, where was I? Inflation was coming down. The labor market remains tight, although improved.
Jay Powell got a sense of humor. If that doesn't make the markets recover, I don't know what will.
Balance. GDP growth in the third quarter was quite strong, but like most forecasters, we do expect growth to moderate in coming quarters. Of course, that remains to be seen, and we are attentive to the risk that stronger growth could undermine further progress in restoring balance to the labor market and in bringing inflation down, which could warrant a response from monetary policy. The FOMC is committed to achieving a stance of monetary policy that is sufficiently restrictive to bring inflation down to 2% over time. We are not confident that we've achieved such a stance. We know that ongoing progress toward our 2% goal is not assured. Inflation has given us a few head fakes along the way. If it becomes appropriate to tighten policy further, we will not hesitate to do so. We will continue to move carefully, however, allowing us to address both the risk of being misled by a few good months of data and the risk of over-tightening. We're making decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity, inflation, as well as the balance of risks, as we determine the extent of additional policy firming that may be appropriate to return inflation to 2% over time. And we'll keep at it until the job is done. So with that, let me turn to the three questions that I've posed that have arisen from the receding but still elevated inflation we're experiencing today. The first question is, with the benefit of 2.5 years to look back, what we can say about the initial causes and ongoing policy implications of the current inflation. After running below our 2% target over the first year of the pandemic, core PCE inflation rose sharply in March 21. Economic forecasters generally did not see this coming, as shown by the February 21 survey of professional forecasters, which showed core PCE running at or below target over the subsequent 3 years. So the real-time policy questions for policymakers were what caused the high inflation and how policy should react. And at the outset, many forecasters and analysts, including FOMC participants, viewed the sudden upturn in inflation as mostly a function of pandemic-related shifts in the composition of demand, a disruption of supply chains, and a sharp decline in labor supply. The resulting supply and demand imbalances led to large increases in the prices of a range of items most directly affected by the pandemic, especially goods. In this view, as the pandemic abated, our dynamic and flexible economy was likely to adapt fairly quickly. Supply disruptions and shortages would diminish, labor supply would rebound, aided by the arrival of vaccines and the reopening of schools. Elevated demand for goods would shift back to services. Inflation would ease reasonably quickly without the need for significant policy response. Inflation spiked in March and April of 21. Beginning in May, it declined for 5 consecutive months, providing some support for this view. But, of course, in the fourth quarter of 21, the data clearly changed amid waves of new COVID-19 variants, with only gradual process in restoring global supply chains and relatively few workers rejoining the labor force. That lack of progress, combined with very strong demand from households, contributed to a tight economy and a historically tight labor market and more persistent high inflation. The committee signaled a change in our policy approach and financial conditions began to tighten. Of course, a new shock arrived in February of 22 when Russia invaded Ukraine, driving up prices of energy and other commodity prices. By the time we lifted off in March, it was clear that bringing down inflation would depend both on the unwinding of the unprecedented pandemic-related demand and supply distortions and on our tightening of monetary policy, which would slow the growth of aggregate demand, allow supply time to catch up. Today, these two processes are working together to bring inflation down. The FOMC has raised the federal funds rate target by 5.25 percentage points, and we've reduced our securities holdings by more than $1 trillion.
So we can see NASDAQ breaking through that weekly low right now. Let's see if that selling pressure is sustained. Not really much news happening here, which is why I don't think that this is going to be a genuine, like a real big drop, because there really isn't any crazy news here. He's just kind of explaining what the Fed has already put out as part of their public disclosure of, their economic reports. So this is not anything new. However, it seems like the market is using this as an opportunity to sell off. So let's just keep an eye on market activity. So far, we are breaking through the lows. I'm hopeful that NASDAQ bounces back up. But of course, I have to see the market give us that confirmation first. So I'm keeping my eye on that. If I see the appropriate confirmations, like I'm genuinely considering jumping in the longs at the weekly low here. But I do want to see a bit more of a rejection, and then I'll end up catching the pullback back in.
Policy should limit its response to.
So right now, sellers in control. However, I'm hopeful that we get a recovery, only because there's no real bad news here.
Many argue as well that in the future, supply disruptions are likely to be more frequent or more persistent than in the decades just before the pandemic. A second question then is what we've learned about this standard looking through approach. The idea that the response to the inflationary effects of supply shocks should be attenuated arises in part from the.
I just put in a small buy position only because I have a great risk and reward at this area. It's a 30-point stop loss, but with a 140-point take profit. So this thing is like a 1-to-5 trade almost, 1-to-4, 1-to-5. And so I'm taking it just off the back that if there is a recovery, this is going to be the best price. I put a small position in because I don't want to give back the profits I made on that first buy from earlier today. So I did put in that position. Just wanted to let you guys know.
Food and energy prices critically affect the budgets of households and businesses. The policy tools of central banks work more slowly than commodity markets move. So responding aggressively to quickly passing price increases could exacerbate macroeconomic volatility without supporting price stability. Our experience since 2020 highlights some limits of this thinking. To begin with, it can be challenging to disentangle supply shocks from demand shocks in real time, and also to determine how long either will persist, particularly in the extraordinary circumstances of the past 3 years. Supply shocks that have a persistent effect on potential output could call for restrictive policy to better align aggregate demand with the suppressed level of aggregate supply. The sequence of shocks to global supply chains experienced from 2020 to 22 suppressed output for a considerable time and actually may have persistently altered global supply dynamics. Such a sequence calls on policymakers to use policy restraint to limit inflationary effects. Policy restraint in this case is also good risk management. Supply shocks that drive inflation high enough for long enough can affect the longer-term inflation expectations of households and businesses. Monetary policy must forthrightly address any risks of a potential de-anchoring of inflation expectations, as well-anchored expectations help bring inflation back to our target. The sharp policy tightening during 2022 likely contributed to keeping inflation expectations well anchored. My third question, then, is the level where interest rates will settle once the effects of the pandemic are truly behind us. By 2019, the general level of nominal interest rates had declined steadily over several decades. As the pandemic arrived, many advanced economies had below target inflation and low or mildly negative rates, raising difficult questions about the efficacy of interest rate policy when constrained by the effective lower bound, or the ELB, as we call it. Over 2 decades, an extensive literature had identified a number of possible changes to the widely used inflation targeting regime, including negative policy rates, nominal income targeting, and various forms of makeup strategies, under which persistent shortfalls in inflation would be followed by a period of inflation running moderately above 2%. Today, inflation and policy rates are elevated, and the effective lower bound is not currently relevant for our policy decisions. But it's far too soon to say whether the monetary policy challenges of the ELB will ultimately turn out to be a thing of the past. The prolonged proximity of interest rates to the ELB was at the heart of the monetary policy review and the changes we made to our framework in 2020. We will begin our next 5-year review in the latter half of 2020.
All right, I'm in profits on the longs. Granted, it's only 20 points, but great rejection so far. Let's see if we can hold above that daily support at let's call that 265. So if we can hold above that zone here at 265, that support level, then we're going to be looking pretty good.
These are just 3 of the many questions raised by these challenging times. And of course, we're very far from a complete understanding of the answers. Again, it's great to be here today, and I look forward to our conversation. Thank you.
Thank you. Thank you.
So nothing new from what he said. I believe the questions are going to be a little bit more targeted. This looks like a pretty smart group. It's a research conference. So let's see if they ask some more specific questions of Jerome Powell that he hasn't been asked in the past couple months.
Challenges. Like the US and many other countries, it's seen an increase in inflation in recent years, and the Bank of Israel has been acting on it. In addition, like other small open economies, it faces potential spillovers from monetary policy decisions taken elsewhere by major central banks, with a potential impact on currency and capital flows. And we'd love to hear your views. So, Amir, floor is yours.
Wow.
All right. First, it's a pleasure to be here in a conference in honor of Ken Rogoff. We all cherish and follow his distinguished contribution in academia and practice. Sort of in a sharp turn, as we're all aware, Israel is currently at a war following the October 7th inhuman brutal attack by the terrorist organization of Hamas. This is a crucial time for Israel's security, and we thank all those who support us. Our heart.
I'm moving my stop loss to break even. I'm protecting this trade, the entry I got. I know that I showed my screen here for the MetaTrader for a second. It was hard for me to bounce back and forth, but you guys can see my entry. Matter of fact, I'll pull it up now. Let's see this. Here's my entry at 218. So right at the previous discount. We've already had this nice rejection. So what I'm going to do is move both of these orders to break even, and I'm actually going to close one of them with partial profits here. So I secured a little bit of, just at least walked away with something. If this thing continues to push to the upside, good. If not, then so be it. There's no risk on that trade now.
Economies to small open economies, and how do those impact local conditions? The answer to these questions depends on the development of the economy, its specific areas of exposure to the global economy, and the particular shock it might need to react to. Generally, local monetary policy cannot be entirely disconnected from that in the major economies. Yet, local circumstances justify and require setting policy that is tailored in accordance with the economy's structure and needs. Key considerations will include interest differentials, foreign exchange.
I mean, I don't know if this is insensitive or if this is actually sensitive to say, but I think that I'm not really sure why Israel's really concerned with their interest rate policy or their inflation rate. I think there's slightly bigger issues right now than inflation.
Monetary policy was generally similar in many countries because the initial health shocks, as well as many supply side difficulties, were similar. Also, we benefited to some extent from the common monetary framework, such as inflation targeting. And that meant that monetary policy in different economies was predicted to act in a similar manner. Having said that, the differential health shock and related steps, fiscal policy differences, and exposure to supply side effects and commodity prices led to somewhat different policies, consequent inflation and activity outcomes. Consequently, there was more heterogeneity in monetary policy exiting COVID than upon its entry. Israel was fortunate in that sense, with relatively small share of tourism sector and a relatively large high-tech sector, which actually benefited from the increased dependency on remote work. These circumstances led to a wedge between global monetary policy and the required domestic monetary policy. This slide shows that for these reasons and others, inflation in Israel is in the lowest quartile of rates in the OECD. In particular, headline inflation in Israel was low because its natural gas supply and prices were shielded from global developments. The next slide shows the swift recovery of the Israeli economy from the COVID crisis. The level of GDP exceeded its long-run trend already by the end of 21 and stayed somewhat above this trend by Q3 23. And we'll come back to this recovery ability of the Israeli economy. An additional key attribute in Israel that affects potency and effectiveness of monetary policy is the large share of mortgages that are directly tied to the Bank of Israel. Therefore, raising rates influences the stock of almost all homeowners, not just new ones. This is another cause for possible differences between global and local monetary policy decisions. The Bank of Israel was one of the first central banks to respond to the increase in inflation. As a first step, we shrank the unconventional tools employed during COVID, that is QE, FX intervention, and special funding to commercial banks. Relative to its rate of inflation, Israel has been among the first movers. This is another evidence for only partial dependence of SOE on policy taken by major central banks. Here you could see the relative time it took to get into a restrictive zone. The policy the Bank of Israel has in fact set in recent years is consistent with this approach. We are aware of the fact that domestic monetary policy cannot deviate too much from global conditions, but at the same time, we recognize that policy should be set according to specific shocks to our economy, taking into account its fundamental attributes. And you could see over some cycles are shared and some are not. Let me show you some specific shocks. We learned over the years that there is a strong connection between the S&P and NASDAQ indices and the shekel dollar exchange rate. This is because Israeli institutional investors react continuously to changes in the value of their foreign denominated portfolio. This slide shows this pattern very clearly. The orange tracks the blue. However, as can easily be seen, since the beginning of 23, this strong connection has weakened. This was the time period that potential changes to the judicial system ignited a widespread civilian opposition.
Just a reminder, I am in break even on this trade. I am in break even on this trade. I don't know how to show that using this. Maybe I'm just going to drag my stop loss up. But there is the potential here for bearish pressure, not because of what's being said, but just mostly because of just the market is at an extremely high point. It's due for a retracement. I've kind of had my eye on potential sell-offs, but I'm just trading off of the weekly zone. We're at a very low price on the lows of that weekly range. So even though on the monthly time frame we're hitting those monthly highs, in the weekly, like on this week, we have a low and a high. We're at the very bottom of that range. We're at discounted prices. It's going to be one of the best chances that we had to buy. And so I've closed partial profits, and then now I just have one order sitting in break even, just a heads up.
Therefore, on policy. I want now to move and discuss current developments in relation to monetary policy. An important part in the analysis is, of course, the initial conditions. The Israeli economy is strong and stable. It has robust and healthy economic foundations. We are a global leader in innovation and technology. The Israeli economy has known how to function and to recover from difficult periods in the past and to return to prosperity rapidly. I have no doubt that the same will be the case this time. You could see the growth rate after different military events in the past. Importantly, Over the years, Israel has shown responsible fiscal position as demonstrated by the declining path of the debt to GDP ratio. Israel entered the war with a very solid fiscal stand. Our debt to GDP ratio is just under 60% and a budget deficit which was expected to be 1.5% in 23, following a surplus in 22. There is no doubt the war will have fiscal implications and generate budget pressures. According to initial projections of our research department, which of course, and I cannot emphasize this enough, are accompanied by extreme uncertainty. And assuming the war is primarily concentrated in the southern border and lasts till the end of this year, GDP growth is likely to shrink by about 1% in 23 and 24, and the debt to GDP ratio is likely to rise to somewhat more than 65% by the end of 24, as costs are larger than it was initially projected. As I mentioned in my opening, Israel has been.
I'll be honest, this is supposed to be a monetary policy. This is the Jack Pollock Annual Research Conference in DC. I'm really not sure why the U.S. Federal Reserve, I have no idea what's going on.
Economic policy, fiscal, and monetary, which we in the BOI lead, takes the necessary actions in order to alleviate the difficulties accompanying these challenging times. With the outbreak of fighting, significant depreciation.
Talks of war, usually not good. But what he said was very interesting, that the correlation between the Israeli shekel dollar and U.S. stock markets. They're talking about investment flows. I'll be honest, I have no idea what this has to do with U.S. Fed policy.
Totaling up to $15 billion. Within the framework of the program, the bank is acting in the market to moderate the fluctuations in the value of the shekel and to supply the liquidity required to continue the orderly activity of the markets. The initial high level of the Bank of Israel's foreign exchange reserve at about $200 billion, 40% of GDP, gives us ample space to act to achieve this target. In addition, the bank also put into operation a shekel repo transaction plan and a monetary program focused on small businesses. In parallel, and that's the other side to the approach, from the beginning of the war, the Bank of Israel rapidly formulated a uniform and agreed upon framework that was adopted by the commercial banks and was expanded to credit card companies as well. The framework is focused on those serving in the Army reserves, the population on the borders, and the families of the victims and hostages. These populations will be able to defer for 3 months payments on mortgages, consumer credit, and small business credit without costs. Many of the banks have extended these steps as they are stable, resilient, and have ample capital buffers. In our interest rate meeting on a...
You got to give them credit. This is a very comprehensive emergency strategy of how to deal with wartime monetary policy. So instead of overprinting and then to compensate for the public debt and the lack of economic activity, they kind of have this comprehensive plan of how they're going to subsidize certain failing parts of the economy. And so I don't know if this is the priority, but then again, you can't also let your entire economy slip because of other priorities, because then you're going to have to come back and clean up the mess. So, I mean, I don't know. Maybe this is a good framework for wartime monetary policy, because it does seem pretty comprehensive, both from the consumer perspective, where consumer debt is handled and, you know, they can defer certain payments and kind of put those off, as well as government intervention and government policy as to how it's going to deal with like central banking, foreign reserves, and some of the big macroeconomic factors.
Contributed to the stability, not only of the FX.
So my break even just got hit on NAS. So for now, I'm just going to let this thing ride out. There's still a possibility of a rejection, but for now, I'm just going to let it ride out.
That the public understands that the BOI enjoys the required independence in order to take the necessary steps at these times. Inflation expectations, as you can see in the slides, for the short term and the long terms have remained substantially stable, and our target and are stating that we will be back in the inflation target. The exchange rate has depreciated a lot, but by now is back to the level prior to the war. Let me, so you could see the red line, this depreciated more than previous military events, but it's now back to where it was. Fiscal, let me finish here. Fiscal policy is, of course, central and crucial for the ability of the economy to overcome this crisis and to resume growth in the medium and long term. The government is working on various fiscal support plans, which the bank is playing a key role in advising in its role as economic advisor.
The only reason I could see this is either, I mean, Jack Pollock, maybe it's a Jewish institution, I'm really not sure. But the only reason I could see the involvement of Jerome Powell in this discussion is because of potential future intervention from the U.S. central bank or potential aid from the U.S. central bank to other central banks that may need it, like the Israeli central bank. So they're kind of just pitching how stable they are. So when things kind of hit the fan, the confidence of other central bankers lies on, like, they're basically just building rapport right now. They're like, yo, everything's under control. If we need some help and some money, give it to us because we got things under control. Versus usually during wartime situations, it's very hard to convince other central bankers to support you because it's kind of a dangerous or risky endeavor. So I don't know. The only reason I could really see I don't know. Well, let's let this play out and let's see what the intentions are.
Very much, Amir. We will now move to Gita. Now, of course, in light of what both Jay and Amir have told us, I think the question in front of us at the fund is, how to think about the challenges for central banks and whether central banks have the appropriate toolkit at the current juncture. And I think.
Did you just say central banks?
Very grateful to hear your views, Gita.
I honestly thought it was a Q&A. Bro, they interrupted Jerome Powell during his speech. He barely got 2 words out. He just talked about inflation back to 2%, and now everyone's talking about the world falling apart.
I'm really glad that we're able to honor Ken Rogoff's tremendous contributions to academia and to the policy world through this conference. So, as Pure Olivier said, what I'm going to talk about is some of the challenges that monetary policy making faces in this current inflation. And
so I'm actually interested in this, as long as it's universally relevant.
Living through a period of heightened uncertainty. We know that there are multiple shocks that the world has faced, and unprecedented shocks, the pandemic, wars, conflicts. The uncertainty that I want to emphasize, though, here is about how the current episode of monetary policy tightening has not been your typical monetary policy tightening episode. And that generates its own.
Yeah, it's been the most aggressive that we've ever seen, from almost 0% interest rates to over 5% interest rates in less than a year. That's going to send us into a brick wall. We have not felt the effects of the monetary policy shocks yet. That's why recession's coming next year.
Appropriately raised interest rates quite sizably in this last year and a half, couple of years. And we've seen inflation decline. All of this is standard. But if you look under the hood, I think what is highly atypical is that this decline in inflation has not come along with a rising rate of unemployment, a significantly increase in the unemployment rate, or a significant slack in the labor market. This is atypical because usually the way we think of policy affecting inflation is reducing aggregate demand, and then that shows up in the labor market through higher unemployment. Now, this is true if you look at the US, you look at the Euro area, UK, but also several emerging markets, including Mexico, if you look at emerging Europe and several others. So
what's up, YouTube chat? Welcome back. I know we streamed this morning. You guys are getting lucky, man. Double whammies, 2 in a day. You guys can thank Jerome Powell for that. Let's see if we get some market action here.
Improved supply. And here I'm talking about the decline in energy prices and food prices that have helped bring down headline inflation. The improvement in global supply chains have helped bring down core goods inflation. The business that's still left is when you look at services inflation, where variables like wage growth play a very important.
The sellers are taking back control. So for now, there's no buys. I'm just going to leave that one off to the side for now. I just want to see who's going to win. Sellers are on the higher time frame, seem to be ready for a pullback. They seem to be ready to take the market just a little bit lower. And so I'm just watching that through. I think after the press conference, we'll have a follow through. And then the close of today's session is going to be very important.
You realize that this last mile will likely be the toughest. So if you look at measures of core services of inflation, let me just give you a couple of numbers. The US is now at 5%. The euro area is at 4.5%. These numbers are well above central bank targets. Okay, so what does that mean in terms of policy going forward? The first point that I'm going to make is that means that it's important to avoid premature easing of monetary policy, either through action or through words. Now, this is going to be a challenge.
She just said the worst words possible for the stock market.
We are going to see labor markets have greater slack. We are going to see unemployment rates go up.
Oh my God.
So that's going to be a difficult message
they just
to
called for a
stand by.
recession.
Well, we have to make sure that we get the job done.
Let me timestamp this.
The other reason this is going to be a
2:45.
challenge is because we have lived through a period of inflation that's been high, and the persistence of inflation makes it more difficult to then see through supply shocks, something that Jay mentioned, which is that we still live in this environment where there are numerous potential shocks that can hit the world economy, including the terrible conflict that's in the Middle East that Amir talked about. If it were...
How many short positions does the Fed have on? Let me know in the chats. How many short positions do they have on MT5 right now?
And affect headline inflation numbers. And in an environment where inflation has been high for a while, that can dislodge short-term inflation expectations. And our research has shown that it's very important what's happening with short-term inflation expectations. Because if you can keep that close to your target, then that makes the job of central bankers much easier in being able to bring down inflation while at the same time not needing a big loss in terms of output. So it improves the odds of a soft landing. The other challenge that comes up is what's happening with long-term rates. We've seen long-term rates in the US go up quite significantly in the last several weeks. It's bounced around a bit, but still these are much higher numbers than in the past. So this raises a question, which as a policymaker, does this mean that then that you don't have to do the next interest rate hike, if that's what you were thinking about doing? Because now you're getting the effect that's working through higher long-term rates. And here again, this is tricky given the uncertainty. So let me just explain, which is it depends a whole lot on what's driving the higher long-term rates.
It kind of seems like they put her out there to say everything Jerome Powell can't say.
By expansion.
The issues with long-term rates versus short-term rates was a massive issue right now. The idea that we have to go into a recession and see that labor market weakness, she said slack in the labor market. What they mean is people got to lose jobs in order for us to get inflation under control.
In the US, where you're seeing most of these interest rate increases, the US fiscal deficit is around 8% this year. And it's projected to be around 7% over the next 3 years. Now, there is a question mark of how stimulative that is on the economy. But when you have high levels of deficits, that certainly is something for a central banker to also incorporate when they're trying to make their forecasts about the path of inflation. My second point about what it means for policymaking in this environment is that central banks must be prepared to respond to renewed financial stresses, especially if inflationary pressures persist. So again, there is the last mile that has to be done, but if inflation remains far more stubborn or further it goes up in some more because of other shocks, then that will require interest rates to stay even higher for longer or even increase. And we could be then in a situation where you have an inflation problem while at the same time growth is slowing sharply.
It's called stagflation.
Stagflationary environment.
There it is. The stagflation is the worst case scenario here.
Let out. In that scenario, again, some of our research has shown that we would have a large number of weak banks that represent about 1/3 of global assets, mostly located in advanced economies and in China. That would be a very difficult place to be in, which is why it's important to prepare in advance. This is the time for strong supervision, robust stress tests, and it's also important for banks to be able to augment their capital buffers at a time when they're making currently very high profits. Banks should also be prepared to quickly access central bank facilities if needed, so that we don't have a repeat of an SVB phenomenon. And much more efforts need to be made to address the risks in the non-bank sector. The third point I'd like to make about policy in the current juncture is that policymakers have to be prepared for more cross-border pressures from increased divergence across economies, increased divergence in policies across economies. So let me give you an example. If you compare 10-year yields in China in its own currency to 10-year yields on US treasuries, for the first time, the numbers have flipped around. So we actually have yields in China treasuries, 10-year treasuries are now around slightly less than about close to 2% lower than the yield that you can get on US treasuries. Now, that obviously puts lots of pressure on exchange rates. And so I'm going to conclude with a few thoughts on what it means for a central banker, especially of a smaller open economy that's facing pressure from weakening currencies in this environment where yields could look very different for a while. This is based, by the way, on a lot of research that we've been doing at the fund. It's called the Integrated Policy Framework. Okay, so first, what does this mean for exchange rate interventions? I think the important thing for central—
This is the part that's relevant for Forex.
That the exchange rate movement is being driven a lot by fundamental shocks. So it is being driven to an important extent by interest rate differentials, which means that in such an environment, exchange rate flexibility has a very important role to play, and it helps you with adjusting. But of course, on the other hand, what can happen is in an environment of heightened uncertainty, you could see exchange rate movements entering zones that then pose a risk in terms of financial stability concerns, especially if you have shallow FX markets. And there's also this risk, which I often hear, that you might have exchange rates going past some psychological thresholds, which then can lead to non-fundamental behavior in these markets. So in this environment, of course, in these specific cases, FX intervention can play a useful role. But this is going to require judgment, and this is the hard part, which is telling apart when is it truly fundamental and when is it non-fundamental for which intervention should happen. I think the basic policy has to be not that the only thing that matters is if you see a sharp movement in the exchange rate. A sharp movement of the exchange rate can truly reflect differences in fundamentals. But it has to be a sharp movement in exchange rate that then interacts with some friction in the economy. And you can see that through, say, deviations in uncovered interest parity or covered interest parity that then tells you that this shock is getting amplified through frictions, for which you certainly interventions can help. And the last bit on FX policy is just to remember that there is no free lunch. Countries have a certain amount of FX reserves. If you use it, deploy it at a time when it's not really needed and prematurely, then that, of course, means that you're going to have less to use when you are in a more difficult period. So with that, I have 30 seconds just to conclude and just to remind everybody in terms of the 3 points I made, which is firstly, the job of bringing down inflation is not done in many countries, and that requires that you to avoid premature easing of monetary policy, either through action or through how you communicate. Second, it's important for central banks to be prepared to respond to renewed financial stresses and also to buffer the financial system. And third, for policymakers to be prepared for more cross-border pressures because of increasing divergences in policy stances across economies. And I'm going to stop there. Thank you.
Well done. She said a lot, and none of it was good. All right, none of it was good for the economy, but it was very well put, extremely brilliant. I don't know who that was, but definitely going to look into who that is.
Both
We'll go through some of the main points that she covered at the very end. I want to make sure that I don't miss some of the key things they're saying, but this is that what she just said was extremely relevant to monetary policy everywhere. And the biggest takeaway here is that the inflation fight is not done, and not to start easing, not just in action, but she's urging the rest of the central bankers not to start easing in their language. She's telling Jerome Powell, look, I know that December is coming up and you're usually very soft on policy and you don't want to panic markets, but this is not the time to start easing verbally either. And so I think that that's a stern warning that if we go down that route, it's going to be trouble.
For this panel, Pierre, Olivier, Amir, Jay, and Gita for participating. Jay, I certainly appreciate how valuable your time is, and Amir, I don't know how you found time to come here, but thank you. It is an extraordinarily difficult period, and in terms of shocks. And I know when you're giving the World Economic Outlook, Pierre Olivier would probably always say that. But one of the things here, celebrating my 70 years, I've been around the block, and this is pretty bad. I mean, I think you'd have to go back to the 70s to think about a period that really compares to this. And even if you don't encompass the global financial crisis, but just have the pandemic, and I don't know how to say this, apolitically, but the rather radical shifts in US policy from one president to the next, and the various implications of that, the pandemic, war in Ukraine, now war in the Middle East, and this really fragmentation of globalization is really something extraordinary.
I don't know how to say this apolitically, but let me just reference politics so I can make it political. Could have just said it's about policy instead of mentioning the political aspect of it.
Get it?
Who knows?
I want to say, I can think of, there is sort of one silver lining, and I must hesitate to say it because if I'm identifying something the IMF seems to have done right, then it may immediately go wrong. But the thing that has surprised me, and it surprised me a lot, is how we've had the pandemic, global recession, rising interest rates, inflation, and we have not had a major emerging market debt crisis. Forgive me, Argentina.
Yeah, we had Venezuela, we had Argentina, Lebanon. This is not
stunning, and again, we don't know what's around the corner. But I
think we do.
Would give
we can look ahead of
the IMF a little credit here, and there was all this for years talk about the Washington Consensus and the evils of the Washington Consensus. And you may not have followed it, but there were many alternatives, notably the Buenos Aires Consensus between the presidents of Venezuela, Argentina, and Brazil back in the early 2000s, and much praised by many progressive economists. And without going into the details, I would say the way people characterized the Washington Consensus was something of a caricature. It wasn't, it was sort of picking extreme versions of each policy. And yet, if we look at why haven't emerging markets had a financial crisis, it's, in a sense, they've adopted, at least in the macro sphere, and probably particularly in the central banking sphere, some version of the Washington Consensus. Now, one was to have a lot of reserves. That's really not in the Washington Consensus, and the Japan and the Asian economies deserve credit for that. And now everyone's imitated that in a dollarized world, it provides a lot of resilience. But there are certainly other elements. Regulation's gotten a lot better, and I have to say, whenever I had to sit in on meetings about regulation,
You guys know what the problem with today's attention economy is, or today's attention span is, that I want to skip forward like I'm watching Netflix, because I want to get back to something that's a little bit more insightful. Because what that lady that was speaking before him, well, put her in charge. But I don't know of what, but I don't know who this guy is. But if this is the decision maker, talking about some fucking maybe
economy,
like he said so much, but I cannot pinpoint what this man just
the
has just
central
said.
bank independence, which I'll talk about in a minute much more, that's been an extraordinary development and allowed many of these things
Oh my God.
to persist. So anyway, that has been a silver lining in a very difficult situation. So I'm going to pick up on a couple topics. I want to start with interest.
Get Jay Powell back on stage. No one cares.
About where do we think long-term interest rates are going? I think, like any financial variable, it's actually very hard to know. But I think if you take a very long-term view of long-term real interest rates, and I gave a paper at this conference last year about it, I've done other work with Barbara Rossi and Paul Schmelzing. You see that over the long run, there is a very gentle decline, but it's much more gentle than we've seen over the last 40 years. And there's been sort of a lot of work trying to rationalize what happened over the last.
So the lady who was speaking right before, her name is Geeta Gopinath. She's the first deputy managing director at the IMF. So that makes sense. I put her in charge, unbelievably competent. This individual, I believe, is Kenneth Rogoff. Or actually, hold on. Kenneth Rogoff. Mauritius C. Boas is the chair of international economics. No, I think I read that wrong. Hold on. No, I read that right. Kenneth Rogoff and Moritz C. Boas is the chair of international economics at Harvard University.
Have expected that to be permanent. And of course, the same might have been true how much it rises here. It's difficult to tie the trend.
Imagine this is your professor.
But what is certainly true is long-term rates typically are very volatile. That was somewhat mapped.
Yo, we got Elise and Creedy Trades out here in the chat. It's good to see you all on here.
The chair of the Fed has talked about where the central banks just couldn't do anything. And that provided, I think, took away some of the volatility. My own guess is that we'll be looking at significantly higher interest rates, certainly at least like they were a year ago. And I'm talking about forward-looking real interest rates, and perhaps higher for the rest of the decade or more. Again, there's volatility around this, and I'm talking about the long rate, not the short rate. And yeah, I think there are many reasons for this, but one is deglobalization.
I think NASDAQ can head down to 15,141, which is the daily, sorry, it's the 1 hour. That's that retracement level that I was watching earlier. So 15,140, that could be a potential re-entry zone for NASDAQ. Maybe a bit lower. Let's call it 135. 15,135 could be another potential buy zone.
You know, I've been to conferences at the IMF not so long ago, and Olivier knows this. Not him as a speaker, but we were jointly organizing one where one of the.
So these are the cells that we were looking for yesterday, and the cells that we were looking for earlier in the week. Higher time frame, we're due for a retracement, but the overall trend is still bullish. So even though we're seeing sellers come in, it's long overdue. That doesn't mean the market is shifting its direction just yet. I think this is a much needed pullback so that we can continue the original direction of the trend, which is bullish for stocks.
Put probably downward pressure on interest rates, but there's strong pressures in the other direction. Let me say a few words about central bank independence, which I think it has been
Let me just talk over this guy because it's kind of boring. There is no central bank independence. This whole idea that every central bank can create policies within their own borders in a global economy where currencies are relative to each other, where FX currency reserves, like Geeta just mentioned, or some of the backbone of funding for some of the countries when they need it. I genuinely think that there's no independence. If America prints, everyone else got to print. If the USA stops printing, everyone has to stop printing more aggressively. That is like they're out here like talking it up like, hey guys, we're making some changes and shifts to the dependence of the rest of the world on Federal Reserve policy, but you can't get away from it. The developed nations set the pace.
It has inflation targeting in it and looks at intermediate targets. I will finally also say that I mentioned this morning about how hard it is to get papers published when you're junior. I couldn't get this one published. I submitted it. One place I sent it was to the JP, where Barrow sent it back by return mail saying, look, there's not going to be an institutional solution to this problem, the super game. I got it rejected by IMF staff papers at the time.
This is why you don't let academics create policy, but you got to push that shit through. This guy's like, well, I tried to mention it once. You could have saved the world.
Successful. I will say that, in sort of trying to apply it, you have to have some humility. You can't think there's some rule that just explains everything.
It's not humility. It's pragmatism, and you got to be rational. You can't just be idealistic. The rest of the world does not give a shit about your central policy. So how does this affect them using the incentive structure in that the whole world follows? These central banks all have their own incentives based on their policy goals. And so in order to create independence, you have to find a way to decouple the whole world while having some kind of layer that we all have in common. So you really can have independence. This really is an idealistic idea.
So,
because then you have to add in politics, geopolitical goals, national security, and then you have to look at sovereignty. And all four of these things are antithetical to central bank independence from each other. Unless we go into a completely deglobalized world, which I also feel like is a massive, like an ideal. We can't decouple from this globalism that we've built.
Justice and on and on. And you can see this in central banker speeches. I haven't checked Amir's or Jay's, but you can see this. They're under tremendous pressure to address these issues. And people say, well, you can walk and chew gum at the same time. But there's a question of the instruments to do that. They're regulatory instruments, but they're very second order in most countries. The central bank's not the only one. And the interest rate is a very blunt instrument. We're certainly, it's possible with these inflation, having experienced inflation and these different times, it will change. I cannot overstate these pressures that I just mentioned on central bank independence. So let me give you, give you a couple of data points on this. First of all, a friend of mine retired recently from being the head of research at a regional Fed, I won't name it, wasn't on the East Coast, and said, I was the last one working on monetary policy in my department. We have 9 or 10 people. They work on all these other issues, inequality, the environment, the weather, but they're not working on monetary policy. And I'm sure that's changed, but
it has not. It's only gotten worse, but shout out to him for calling it out, that the Fed should stop being political and should stop fighting these social justice battles between trying to create equity and inclusion and all this other dumb shit. They should focus on monetary policy before they send the whole world into a shitstorm. All right? If people are uncomfortable with certain policies and certain societal issues, society needs to deal with those. But you can't have a central bank interfering and getting their priorities mixed up, trying to appease a certain class.
Sure. And there were a few questions, but I'll just pick on one. In 2000, they asked, should who should take the lead in short-term stabilization policy, the Federal Reserve or fiscal policy? And in 2000, it was like 75-25 monetary policy. I don't know where the 25 came from, but they had that. And then it flipped in 2020, which is really hard to get your head wrapped around when you think about how political fiscal policy. I mean, look at what's going on in the U.S.
It's not hard to understand at all. In the past, and even now, the Federal Reserve and central banks are responsible for smoothing out price stability and the stability of that currency. During 2020, people needed money in their pockets. The central bank cannot directly interact with the public. They can't give money out to people. And so what happens is they gave the money to the Treasury, and then the Treasury Department, the government, signed bills to give it out to the people. So of course, fiscal policy became more important than monetary policy at that time, or intervention. But the real role of who should be smoothing out these price changes and these micro changes should be, number one, the market itself, and then number two, the Federal Reserve, because their whole job is to smooth out these irregularities in the economic cycle.
75-25, and it
How is this? How is this even a conversation, bro? This should be for Twitter trolls. This should not be for the central bankers themselves and for the Policy Institute to sort of like give this any more air than it needs.
Thank you, Ken. That was absolutely terrific, as we expected. So we've not been disappointed. There's been no turning point on that, at least.
By whose
As we've seen
standards?
today, there are some ways in which central banks are asked to do much.
Dick riders.
Let me maybe open it up to the panelists and see if anyone wants to react to the points that have been raised by others before we then take questions from the floor. So anyone wants to, Kita, please.
Amir,
Finally, give me some.
you briefly mentioned about the use of FX intervention. And I said in my speaking points that it's a pretty tricky thing to tell apart when to intervene and when not to. It'd be great to hear from you how you think about that.
I think one lesson that we learned through economic history is that when financial crises intermingle with real crisis or other events, you can think of COVID as a health crisis, went into an economic crisis, and through a lot of the work of the Fed, we sort of averted a financial crisis. But we know those are the deepest, those have a magnifying effect when the two interact. And that's why when this event had started, it was, and we could already see there was a lot of things going on in Asia and other places regarding the shekel. That was the logic. You want to ensure stability. You want to make sure the markets function. You don't target a particular exchange rate, but you want to moderate things such that the markets function. There is liquidity. And that's that was our goal. And I think, as of.
And by the way, that's the real way that the Federal Reserve is supposed to have intervention, is just to give the market what it needs to solve the issue. You can't just pump the market full of drugs. If it's a patient, you have to give it everything that it needs in order for the body and the natural immunity of the body to work at its best capacity. Okay. And usually it's not just pumping it with a bunch of hard drugs. Usually that really could be diet changes, health, nutrition, and maybe some potential medical intervention. So for the Federal Reserve, it's the same thing. You want to allow the market to fix these issues themselves, not to continue to intervene and make the problems worse over time. Printing money does mess up the order flow of how markets are supposed to operate in this natural function. And so it's important for at least them to touch on that, to show us that they still have their priorities in order.
And that was the way we sort of aimed at it.
So if I can, and in the meantime, if you are planning to ask a question, I will ask you to go and put yourself behind one of the mics so we can directly move to the questions afterwards. But before we turn to that, let me actually follow up with one question for, Amir and Jay. Jay, there's this incredible resilience in the U.S. economy, is that,
This is what I need. I need some J. Powell.
Fine in inflation, and the economy seems to be powering ahead. Growth is really at a very high level. Consumption is very, very strong. There's this question about whether transmission of monetary policy is different this time around. Now, in your remarks, you've alluded to the fact that the sequence of shocks we've had is quite different from the typical business cycle, or and so I was curious, and I would like to ask the same question to Amir, because in the context of the tightening of policy that you have done in at the Bank of Israel, and maybe some of these resilience that Ken was talking about, building a stronger monetary policy framework, building reserves, etc., whether there is a sense in which the tightening operates in slightly different ways, longer delays, shorter delays. How do you view this from your own vantage point? Go ahead.
So I would say a couple things. Clearly, the U.S. economy has been stronger than expected. It's been more resilient, and this year is just remarkable, really. You know, so many forecasters had a recession this year, and it's nothing like that. It's going to be close to 2.5% growth this year. But that's probably, in my thinking, probably significantly a function of strong demand. I think monetary policy is generally working in the ways that we think it should work, which is interest-sensitive spending, asset prices, exchange rate. I think there are some aspects of the U.S. economy where you can argue that it's a little different, and that would be, for example, households who are in low-rate mortgages are not selling their homes, but they're also not feeling the effects of higher rates because they really don't want to get out of those mortgages. Same thing with companies. Any company that had access to fixed rate borrowing and didn't use that in the last 3 or 4 years would be facing, but there are very few companies that are in that. So it may be that the U.S. economy is structurally a little bit more resilient to interest rates, but I don't think that I don't see at this point anything that seems to be structurally or materially in the nature of a difference.
Amir.
He's so good at saying nothing.
I sort of agree.
But he did mention that he's like, look, he's kind of talking his shit because he did orchestrate what he considers to be a soft landing because we're not having a recession this year. Doesn't mean that we're not having one next year, as Gita just said.
The potency and the effect of monetary policy took longer, the adjustments of both supply and demand. But I think at least Israel also had, as I shown, a very strong recovery. And
Noah says the banking system is resilient. Gita just said that it's extreme. I mean, they are resilient right now, but they need to put money in reserves while they're profitable now. We can't wait until a downturn for them to start being more responsible. They need to start beefing it up while they're profitable.
24, it just took, in my opinion, a little bit longer for these adjustments to happen. I also agree with Jay in his speech that the issue of supply, to look through supply, was there's a time to do that, but once inflation gets too high and too long, the expectation channel is so important. And as long as that was anchored in monetary policy, ultimately would kick in. It did take a little bit longer.
Okay, Jay.
I just want to, for a second, go back to something that Ken talked about, which is central bank independence. Unsurprisingly, I'm a believer in central bank independence, but it really is just an institutional arrangement that exists because the elected government allows it to exist, and as long as it serves the public well, it's a fine institutional arrangement. And I think it's easy to forget that we have this precious independence. It should be very, very rare in a functioning democracy that you have an institution that has the degree of independence that we have. Of course, we strive all the time to be democratically accountable and transparent. But I think that the temptation to want...
Yeah, he forgot the part where he's in the pocket of the president because he's not elected. He's appointed by the president.
Strong one, and is to be resisted.
And why is he appointed by the president? So that he can do the president's bidding.
Independence could be undermined. To me, that's right at the top of the list.
Very good. Any other reactions or comments?
And everybody in that room knows that he's lying through his teeth because he has made political decisions, even though the Fed is supposed to remain apolitical.
15 or 20 years, just take it for granted. And they have these very sterile technocratic models and don't realize that central bank independence is something central bankers have to fight for every day. I mean, it's a very political environment with which they have to protect their right to do monetary policy independently.
At least this guy's honest.
Very good. So
Look, as boring as he was, at least he was honest. He's like, we were fighting an uphill battle because they put a lot of pressure on us politically in order to do their bidding, and we're trying not to because our job is to save the patient. They're a doctor, and you have some politician being like, yeah, do this with the patient. They're like, no, man, we got to do it the right way. But sometimes they lose.
And peace very soon. Now, what are the scenarios that you are preparing for? What the kind of the worst case scenarios that you're thinking about?
The projections that we gave, as I mentioned, were contained to a situation where most of the war is really at the southern border. It takes until the end of 2023. It doesn't mean there's no interactions in the war in the north, but there isn't a full-fledged transition into a war there. That's a different ball game. It will have a different impact. There's enough uncertainties even around just the issues of the southern border, just dealing with the southern border, how comfortable people will be coming back to some of the activities around there. The north border will be, if that happens, and we all hope that doesn't happen, this could have a much bigger implication altogether.
thank you. I'm going to go to the back, the lady
Well,
over there.
At least a positive note on the geopolitical front is that even the Central Bank of Israel is not expecting the conflict to spread past the northern border. So they're expecting the southern half of the country to still be good. So that's good. As long as the fighting is contained and as long as the conflict is contained, it won't spread into a world war or some kind of everyone in the world has to take sides kind of scenario. So there's still a way back out of this.
Last many weeks. And I wanted to know if you think it's a changing in natural rates. So maybe Fed funds rate should be a bit higher, or this is just a steeper yield curve, like higher term premium. So maybe Fed funds rates could be. And also I would like to, I'm a bit worried about over tightening on a personal level, of course. So what would be clear evidence for you that rates are in restrictive territory enough, given the lags? I mean, we could be over tightening. That's it.
We will over tighten. They've already admitted to this. Very rational risk fear to have.
On the implications of higher rates, it's when we move the federal funds rate around, the real point is to affect broader financial conditions, and broader financial conditions then affect the economy, the real economy, in ways that we broadly understand. But so we don't target any one financial condition. We look at broader financial conditions. So it's very hard to draw a direct line from one particular thing like higher bond yields to what monetary policy should do. So the first thing you would look at, though, is you'd look for persistent changes. Even then, and so then the question is, and Gita touched on this appropriately, which is why are longer run rates going up? And it really, the reason they're going up really matters. So we have to factor that in. So it's something we're looking at. We're certainly not going to ignore a significant tightening in financial conditions through that channel, but we don't have to decide. We're moving carefully now. We've moved very fast, and rates are now restrictive, and so we're going to be looking at this question, and not something we're trying to make a decision on right now. In terms of I take your question to be why are long rates higher? I think there are many candidate explanations, and 5 or 6 of them. It's easy to get to a half dozen explanations. I think we really don't know. I think one thing to point out, though, is people are experiencing these higher rates are actually affecting people's mortgages. The costs of all their floating rate debt is being affected. So it's having an effect on the economy. That the standard thinking has been that this was largely about term premium. Then the question is, why term premium? I don't want to try to dive into all of that today, but it's something we're looking at carefully and just seeing. In terms of you mentioned over tightening, but how are we thinking? So I would just go back at the beginning. Really, the question was to move as fast as we could. As I went through with the chronology, In early 2022, it became obvious that we needed to tighten policy as quickly as we could, and also at a reasonable pace. So we did, and that was the main thing, was speed. The second question was going to be how high to go, and we're still on that question. We're still on the question of a policy stance that's sufficiently restrictive to bring inflation down to 2% over time. The next question will be how long to keep rates restrictive. And so we're looking at, there is no magic to it. We're looking at the incoming data, of course, but really we're looking at the implications for the outlook. It's really what are we learning about the outlook, the balance of risks, and all those things. And we're trying to make a judgment at this point whether we need to do more. And as I said, we did move very quickly. The speed is no longer, the main thing. The main thing now is to try to get to that right level. Of course, we don't want to go too far, but at the same time, we know the biggest mistake we could make would be to fail to get inflation under control. So that's not going to happen. We will keep at this until we succeed. So moving carefully and looking at all the evidence and trying to make smart decisions on behalf of the public.
Let's go in the front here, sir.
Thank you. I'm Charlie Kimball with the Korea Center for International Finance. Both in
This guy looks smart as fuck.
Israel, in 2020, fiscal policy and monetary policy were in line.
This guy looks like him, but he time traveled back to watch himself say this question.
You have very easy fiscal policy here and presumably in Israel. Does that mean that the real rate of interest that you should aim for should be a little higher?
Amir,
do you want to go first?
I think this situation, I'm not sure we're in a different situation right now in the US. So I think, the job of the government in this kind of an emergency war situation is to supply the needs of many of the people who've gotten hurt from the war, and to try to minimize as much the damage that might be from this event, and that require fiscal spending. There's also, obviously, as Ken mentioned, there's likely to be more military spending over time. And the point that I was alluding to was that we need to find the right balance, where on the one hand, these spending be done, and at the same time go and very carefully find less needed, or especially given the circumstances, items in the budget, and direct them into those spending avenues, such that the fiscal stand over time, and we've demonstrated very responsible fiscal position. And I believe that if we do that, while the debt to GDP of Israel will go up for a while, the fiscal position will retrieve back, and fundamentally.
If only the United States could do the same thing, which is, instead of printing money to fund wars, we had to reappropriate it from somewhere else. And then we'd realize we don't have anywhere else to take it from. And then we wouldn't be in all these wars.
First, the thing to say is that, we stay very far away from commenting on fiscal policy, even indirectly. So I won't do that.
Real independence.
The way I'm thinking about this is let's look at where real rates are. So the federal funds rate's at 5.3 and change. If you take a 1 year forward look at inflation, maybe that's 3. So you've got real rates that are above 2%, and that's well above most mainstream estimates of where the neutral rate might be. I think that our star is as a not a particularly useful way to think about policy, because it can be affected by so many things, and it changes over the short run and the long run. So I think I tend to look at it that we're in the range, we're in the place where we have restrictive policy, and probably significantly restrictive policy, and we're watching the effect carefully on the economy. I think the question of, has the neutral rate risen or will it rise, and will that be because of this factor or that factor, is less interesting given the policy job that we have to do. Of course, we have all the models and we look at them and things like that, but really I think about it as in a more practical way.
Final question, sir.
Dr. Mamadouba from Harvard University and Athletic International University in Hawaii. Actually, the biggest problem in the world economy is inflation. Why the Fed did not change its fundamental goal from unemployment to inflation? If you understand.
I'm sorry, could you repeat that?
Yes, actually, the fundamental goal, the biggest problem in the world economy is inflation. Why the Fed, your bank did not change its fundamental goal from unemployment to inflation like the ECB?
They did. We have a congressionally set mandate of maximum employment and price stability.
They're about to sacrifice employment. Let me
Goals are
listen to this
equal
first.
under the law, and we can't change them. Only Congress can do that. We do have a provision. The question is, what if we're very far from one of those goals and not so far from the other? And what we do is we say this in our constitutional document that we've written. It's not a matter of law, but it's our policy.
And don't get me wrong, it was a good question, but it's just not accurate.
The actual goal. Inflation, we were a year or so ago very far from 2% inflation, and that has been our focus. As inflation comes back down, it becomes more of an equal weighting thing. And when you're equally far away from each goal, then the two are equal because they are exactly equal under the law.
Thank you. So I want to thank our panelists, but I would like to give a chance to Ken to maybe have a final word, since this is this whole thing is for you. So
I think people were pretty interested in hearing everybody else in this particular panel. I will say on this last question about fiscal dominance, it's a very different thing when you're at war and fiscal spending's taking up, I don't know the number, but half of GDP suddenly. Defense spending's taking up half of GDP suddenly, and there's no country which looks at its inflation targeting framework exactly there. Nobody does that. I don't think anyone fully did that even in the pandemic. You don't have to comment, but I mean that had a certain warlike feel at the beginning. It's a very different situation where you really need to reach into the toolkit because the national objectives are now very different than just unemployment and inflation.
So please join me and let's thank all our panelists today.
Okay, well done. Just on two really important topics, just to kind of wrap this up. There was a few things that Gita said that were very important, and then obviously what Jerome Powell just stated. The last question was about the dual mandate of the Fed, which is price stability and maximum employment. That's what the Congress put onto the Fed as their number one priorities. Now, because inflation has become such a bigger risk than unemployment and, well, now price stability is the inflation mandate, but in order for them to fight inflation, which is a much bigger risk, they're going to have to sacrifice employment. And so what we're seeing now is that the Fed has not explicitly changed their mandate on their website to exclude price stability and employment. But what they're doing now is they've prioritized inflation above all else. What Jerome Powell said is that we're going to try and beat inflation. We're going to continue to keep rates higher until we fully flushed it out. You guys can think about inflation like a virus or even like a cancer, which is if there's a little bit left, if you don't completely get rid of it, it's going to come back worse. And so the reason that they're so consistent with this narrative of, we're going to go into a recession, labor market, strikes, wars, cool. We're going to stay committed to our inflation target. He always throws that out there to remind the markets, hey, it's still top of mind. Don't worry. We're not going to, this is not the end of the world. High inflation in America, a resurgence of inflation would be the end of the world. Not the end of the world, but it would be very catastrophic. It would lead to mass unemployment and it would lead to a lot of issues. So the number one risks that Gita mentioned, and this is actually very, very well put on her part, stagflation seems to be the number one risk today. Stagflation meaning this really weird scenario that we really haven't seen, which is a stagnation in the economy, so no growth, GDP flat. But at the same time, we have prices going up with inflation. So if no one's getting paid more, and if economic activity is not growing, but prices are still going up, a lot of people start to hurt. And so the stagflation risk is now top of mind. But Jerome Powell was telling us that he still believes that the soft landing is possible. So we're in the situation where they're going to keep rates higher. They're going to pray that the effects of these high rates play into the market. And then they're going to pray that we don't go into such a deep recession that we have to start printing. But that's exactly what's going to happen. I hate to break it to everyone. This is inevitable. If you continue to have rates high, eventually it will bleed into the real economy. And then at some point, the Fed will have to intervene. And so by next year, I think that we'll start to see the recession unwind, or not unwind, but to unfold. And then we'll start to see the Federal Reserve starting to talk about potentially lowering rates. And that's where we'll see the massive, massive recovery in stocks. So that's kind of what next year looks like. I hope you guys enjoyed that breakdown. Drop a like on the way out if you don't mind. I'll catch you guys later tomorrow morning, fresh stream for Veterans Day. And yeah, happy and safe trading, everybody. Peace. Boom.